All right, guys, we are coming up on 8:30 UK time. So let's just quickly take a look at where we are across major asset classes, looking at sentiment. Now, sentiment is pretty mixed, but we are leaning more sour right now, more risk off. And it's all still to do with Europe. This one chart that we're about to look at basically explains everything that we need to know about why the market is trading the way it is. Look at this. This is the spread. We looked at this earlier in the week as well. This is the spread between French 10-year yields and German 10-year yields. Now, not traditionally seen as a peripheral spread. Obviously, when we talk about peripheral spreads, that's more to do with Italian 10-year versus German 10-year, or Spanish 10-year versus German 10-year. But in this case, looking at how the markets are reacting, we'll consider this a peripheral spread for the short term, because I mean, France right now is trading with a massive amount of risk premium behind it. Why are we seeing this move? Well, everything, of course, happened over the weekend with the failed parliamentary elections on the French side, with Macron obviously taking a massive beating and calling a snap election as a result of it. We saw the markets, pricing in a bit of risk premium on Monday, but things really started to increase on Tuesday. Yesterday, we saw another bout of uncertainty, and today the markets are just going absolutely crazy. It obviously doesn't help when the French finance minister comes out and when asked about whether the current political crisis could end up in a financial crisis, then saying yes. That obviously doesn't help sentiment at all right now. And the markets are just freaking out a little bit here. I mean, this is a massive ballooning of the spread between French and German 10-year yields. And it's the same story across the board. It's not just obviously on the French side. We are seeing risk premiums being built up across the board. This is looking at the classic BTB Bund spread, which is normally what you would consider your main peripheral spread that the markets always look at from a risk sentiment point of view or a risk premium point of view. And even that saw quite a big ballooning to the upside. I do think that right now, that is the main reason why the dollar is trading the way it's trading. I mean, if you take a look at the volatility across major currency pairs right now, the implied volatility 1 month, we can see that we've been drifting lower across the major pairs, which is normally considered a negative input for the US dollar. And right now, one of these charts, only one of these lines are not like the others, right? And that's the euro. Big move here to the upside. And that, in my opinion, is why we didn't really see the dollar react the way that we would have anticipated to yesterday, on the back of what was just ugly data on both the labor as well as the inflation side. It should have been more negative for the US dollar. And again, in my opinion, the reason why it wasn't is because of this risk sentiment. When things go really, really bad from a European point of view, the dollar tends to be the benefactor, or at least one of them. The other benefactor, which we can see evidence of today again, is the Swiss franc. If we go back to yesterday's session at the start, you can see that the two currencies that are just flying ahead of everybody else is the dollar as well as the Swiss franc. So that shows you everything that you need to know. It's all about European risk premiums right now. Now, the challenge about this is it's obviously right now dragging European equities lower as a result of it. It's dragging the euro lower as a result of it. The challenge when it comes to these types of things is that the markets always take things too far too quick. There's a lot of research that's being done that shows us that the markets tends to price in negative political shocks, especially geopolitical shocks, very aggressively, very quickly, like we're seeing now in FX, but it tends to reverse then quite aggressively, where when you have more positive political and geopolitical shocks, the FX market especially tends to price that in over a longer period, giving you slightly better bang for your buck if you get in on those trends at the right time. When it comes to negative news like this, the market tends to get super aggressive, super quick, but the bounce is equally as aggressive as well. So that makes it tricky trading stuff like this, because you want to be short European equities right now. You want to be short the euro right now. But do you want to be the guy that shorts it into the hole just as that aggressive pricing starts to take a bit of a mean reversion move? I certainly don't want to. But you also don't want to be the guy that tries to catch the falling knife, because that's just going to get you that's going to hurt. That's going to hurt, and that's not a strategy for the long term from a tradability point of view. So the bottom line is, we know why the markets are reacting the way it is. Right now, the edge to try and capitalize on that, it's just not attractive, at least in my opinion. If you've got an edge trading this, from a political point of view, then by all means have at it. But for me, you know, it's way too messy. It's way too unpredictable. It can turn around at any time, which just doesn't make it attractive to trade. It also means that, you know, because we had, you know, just the perfect type of miss yesterday for the US data, because that didn't even move the needle for the markets. I just don't think there's a lot of edge to trade things like the University of Michigan data coming up later today either. You know, can that be market moving? I mean, maybe, especially those 1 year and 5 year inflation expectations. That has tended to be what the markets have focused on in the last few months. But if the markets aren't going to react the way it should have to things like a massive jump in jobless claims, I mean, take a look at this chart for jobless claims yesterday. That was a shockingly shockingly big jump. You know, the markets are paying or should have paid more attention to this. They didn't. PPI had a massive miss. The markets just shrugged it off. So if the markets are going to shrug off something that's this bleak on the back of a big miss in CPI, do I really think it's going to react to University of Michigan data? I don't think so. I think the main focus point is still going to be on Europe, what's happening to the geopolitical situation. And, you know, at some stage, the markets are going to price in, like we said, they're going to price in too much risk premiums, which is then going to create some fantastic bargain opportunities for European equities, bargain opportunities for the euro. And when that happens, we can look for some bargain opportunities to short the dollar. But I'm just not going to take that risk going into a weekend, right? Not on a Friday. There's just too much that can go wrong. Let's see what happens over the weekend. Maybe we get some type of good news, maybe some resolution. Would be fantastic. If we get that type of thing, then obviously then that makes trading next week a lot simpler. But until then, you know, we know what's driving markets. There's just not a lot of edge to get involved in that right now, at least in my opinion. I've got very, very little appetite for that where I'm sitting right now. Now, in terms of moves across markets, let's just quickly take a look at where we are then across asset flows here. In terms of equities, mixed on the US side, where the NQ is holding up a little bit, but the weakness that we've had in the Russell and the Dow, that's continued. That's been exacerbated throughout the session. It's also now seen the ES just dipping into negative territory. Obviously, when it comes to EMEA equity futures, it's all about the stress on the political side. That is just weighing and dragging European equities lower. Again, at some stage, this is going to provide for some fantastic bargain buying opportunities, but it's risky. It's risky to call that bottom, without having a resolution in play, without having a solution for that in play. Again, a catalyst would be fantastic. If we don't get a catalyst, then I'm not gonna go crazy trying to call that type of bottom on a Friday, right? Let's just wait for the situation to calm down first a little bit. But that's what's dragging this lower. Asia Pacific equities are surprisingly more resilient today. Seeing some of them trying to catch up to the earlier weakness that we've had throughout the week. Again, I think right now the problem when it comes to Asia Pacific equities, specifically China ones, is that the markets we're running out of patience, right? We want to see the growth data starting to show us some positive news, and we are yet to see that. We've got a couple of data points coming up next week, I think, in the form of retail sales. That could be interesting. If that comes in super, super hot, then maybe there's some upside opportunity. But for now, the markets are running out of patience, and we'll need to start seeing the data surprise higher to get us conviction to trade that. To trade that even higher from here. In terms of the commodity space, seeing not precious metals across the board, just gold pushing up. I think this is gold starting to get a little bit of a bit from a geopolitical point of view. When it comes to risk sentiment, a lot of traders will look at gold as a classic, quote unquote safe haven. But if you do a proper back test on it, gold really doesn't trade as a traditional risk sentiment safe haven. When gold trades as a risk sentiment safe haven is when geopolitical risks are heightened. So it does make some sense in today's session why we would be seeing gold trading with a slightly bigger bid. But I won't be trading gold as a geopolitical hedge right now. Not when the dollar is doing this, right? The dollar is just absolutely soaring here on the back of this political stress, this risk premium that's being priced in. And that for me makes gold a little bit more complicated, a little bit more risky at this stage. Apart from that though, commodities struggling here. We're seeing silver struggling, copper struggling, iron ore is giving up some of those earlier gains, platinum is pushing lower, oil is basically flat to lower as well, and I think that is all down to the slightly stronger dollar. I mean, you know, to be fair, I would have expected commodities to be a little bit more pressured on the back of this move in the US dollar. But again, you know, for now, commodities, it's a tricky one for me. It's one it's one we always watch, but one that I'm choosing to just keep on the back burner right now. In terms of the bond market, I mean, take a look at yields. That tells you everything you need to know about the stress in the markets right now. Bonds catching a very classic safe haven bid here, with bonds pushing up, yields pushing lower, again on the back of the geopolitical or political shenanigans we are seeing in France right now. In terms of the FX space, we've spoken about the euro quite a lot, but obviously the euro is just pressured here in the session on the back of the geopolitical stuff going on. The yen is still the weakest, which, you know, to nobody's surprise, came on the back of the BOJ, where they once again wrong-footed the markets. You know, that's what these guys do. That's why I don't like trading BOJ policy decisions, as I explained earlier in the video that we do. These guys, they love playing the markets. They love playing with the markets. They would deny it, obviously, if somebody were to ask them that, but they love it. You know, they always release some type of leaked information to the markets to see how they react. We've seen this so many times, where they say something, it gets leaked, the markets prices it in, and then they do something the exact opposite or don't follow through at the meeting. We've seen it so many times, which is why I ignore the BOJ meetings. It's just not worth the volatility. It's not worth the risk. Not when they like playing the markets like this. What happened obviously last week, we had a sources report coming out from via Nikkei, who said that the bank will be contemplating potentially reducing or announcing or reducing bond purchases at this meeting. So that led the markets to start pricing in the possibility of that happening. A lot of players out there were looking for a reduction of about 1 trillion yen from the current monthly purchase of 6 trillion. So basically taking it down to 5. And what the bank decided to do today is to announce that they are planning to eventually cut bond purchases, and announce what that would be, hopefully at the incoming July meeting. So it's very clever, because headlines say that they made a decision to cut bond purchases. Well, they made a decision to cut bond purchases, but they didn't cut bond purchases, right? They didn't follow through with that taper. It's them basically just kicking the can down the road, basically having their cake and eating it. It's a horrible situation to trade, which is why I'm happy. I am completely flat on the yen. There's no positions, no exposures running, and I'm happy with that. It's been a dog to trade the Japanese yen on the back of BOJ policy. It's just not been a winning trade by any means. So that's the volatility we're seeing there in the Japanese yen. The Kiwi dollar here, I think, is weak on the back of the pretty bleak PMI print we had a little bit earlier. I'm sure I have that chart. Just give me a second to bring it up for you guys. We had PMIs contract again, down to 47.2, I believe. Let me just see if I can find that chart. Sorry guys, I should have had it open. Here we go. So we printed 47.2 from the prior of, I think it was 48.9. So this doesn't bode well, especially going into growth data. We get released the quarterly growth data next week. There were some earlier reports coming out from ANZ, who believes that, you know, they think the RBNZ overstepped their recent projections for the OCR, and they believe the OCR will need to be revised lower, because they do think growth is going to start taking a move lower, starting to surprise to the downside. And obviously, when you look at things like this PMI, it does look like that could be possible, you know. So this lower PMI print doesn't bode well for the incoming GDP print coming up, I believe, next week on Thursday. And I think that might be why we are seeing the Kiwi dollar just giving up some of its gains in the session. That PMI print has also been enough for me to get out of my remaining positions that I had running on the Aussie Kiwi. Remember, we got into this on the back of the RBNZ policy decision on the 22nd of May. We've been able to take profit on the way to the downside, and I had some exposure running still, which I wanted to take profit a little bit lower, but I never set my profit target at that level. And by the time that I got to to this chart, it was already a little bit higher. So I decided to just let it run and see what we can squeeze out. But now it's starting to get to too close to major incoming events, which could see this, you know, jumping back up a little bit. So I've decided to get completely flat on that Aussie Kiwi position. So completely flat on this running into the GDP data next week. Now, like I said, in terms of the calendar, I mean, we've got University Mish coming up. I don't think that's gonna be tradable. Look, don't get me wrong. This thing has created volatility over the last couple of months, and if the data should come in absolutely, you know, perfectly synced, you know, sentiment coming in super hot, inflation coming in super hot, sentiment coming in really bad, and the inflation projections coming in really low, maybe there could be some volatility there. But personally, I'm not going to try and trade the dollar on the back of that. The markets right now seems to be only focused on this political situation, and until that passes, I'm not going to take that type of risk on University of Michigan. Like I said, if the PPI and the jobless claims data yesterday, which was, in my opinion, you know, a perfect example of a dovish print, an ideal dovish print, if that wasn't going to be enough to push the dollar lower after CPI this week, then I just don't think University of Michigan will be on the market's minds today. Again, it doesn't mean it can't be market moving. It's just not going to be something that I want to risk my own capital on in a session like today. So just be very, very careful out there. The markets are very focused right now on this political situation. The markets are freaking out, as they always do, and probably pricing in too much of a risk premium at this stage for what could potentially happen. But let's just keep a close eye on it. If we do see any major developments, we will of course make sure to let you guys know.